welcome to why cryptocurrencies just entered a new bull market. Now, for most of you who have known me for a while, I say that with major probability. Obviously, it is not a certainty, only an opportunity that we're here to explore today. And what I'd like to share with you today are the different catalysts that we see that are ongoing and that could drive cryptocurrency markets in the months and years ahead. Now, so let's begin. I'd like to start with a few disclaimers first. First is due to the so when we promoted this, we were very surprised to see that the promotion was well received and the reception that we got. And we were actually very surprised to get inquiries from a lot of people who don't have financial background. And because of that, first disclaimer I'm going to make is, number one, I'm going to try to give this webinar in the simplest way that I can, while at the same time giving a lot of insight for those of you who have been trading financial markets for a while and who have been trading cryptocurrency markets for a while as well. The second disclaimer that I want to make, and more important, is that what I will be discussing today are purely macro narratives. It's a macro narrative as to what's going on right now. And it's the macro narrative that's driving not just cryptocurrency markets, but also commodity markets, gold, silver, nickel, copper. And for those of you who are already trading, most of you might know that when it comes to relative strength, when it comes to where the pockets of strengths are in today's financial market, let's say in the local market, most of you maybe have been focused on stocks like Nickel Asia, APX Mining, Philex, Lepanto, Mark Ventures. For global markets, you've also seen a lot of the mining companies outperform all of the other sectors. And what I will be discussing today will be value adding also and explain why not just cryptocurrencies, but commodity stocks and commodities in general are moving higher. Now, since this is a macro narrative, I would like to stress as a very important disclaimer that it is not a recommendation to buy. I purposely shared this or prepared this as a macro narrative and did not include other aspects of the analysis, such as the timing aspect on when to enter, when to exit, which if for traders there, you know, is very extremely important. And also the security selection process, meaning how to choose stocks, which stocks to choose, which cryptos to choose, which commodities to choose. That's something that I purposely did not include here and reserve that strictly for Buhawi clients and for our open journal community and family. Now, so with that, I'd like to start. This is the cryptocurrency market for the past 7 days. This is from cryptobubbles.net. And I show this because I'm sure most of 90% of the people here have been trading either Philippine market or US market, or some even Forex markets. And just to give you an idea on the relative outperformance, if you look at the past 7 days, this is just some of the performance of some of the cryptocurrencies the past 7 days. So this is Mana USD, which is something that we recommended 5 days ago. It's up 80% in just 5 days. You have other cryptocurrencies such as Ant, Sol, Nest up 220%, BAL 99% up, NMR, Band, which is a substitute for Chainlink, that's up 112%. So if we go back the past 30 days, these are how cryptocurrencies have performed. So you see the same outperformers. You see Band up almost times 7, Ocean times 4, Mana more than double, Kava, so on and so forth. So you see that it is not just an area of strength in selected cryptocurrencies, but it is also a broad-based move higher across the whole space. So here, outlined in stars, are the 3 largest cryptocurrencies. You have here Bitcoin, which over the past 30 days has been up 25%. Here in the middle, you'll see Ethereum, which is up almost times 60%. And then Ripple, which is the third largest cryptocurrency, is up 40% just the last 30 days. Moving back to the last 365 days, which has been, it's been a very good year, at least for some of the cryptocurrencies or some of the up-and-comers. If you have been watching closely, you have Tezos here, which is relatively a more popular cryptocurrency. It's up almost ×3. You have Lend, which has been the biggest outperformer. That is up, I mean, I don't even know how to count this. This is up ×100, if I'm not mistaken. It's ×100 the past 365 days. And just to give you some perspective, if I asked you, or if I surveyed most of the participants today, which market would be the strongest market, most of you would probably answer the US market. Even some of you would answer tech stocks. Just to give you some benchmark for comparison, the number one tech stock that is up for the year is Tesla. And Tesla, for the past 365 days, is up ×6. It's up ×6. And that's already an outlier. If you look at the second highest performing NASDAQ stock in the States, that is Nvidia, which is up 94% for the year. If you look at the third, that's AMD, which is a chip manufacturer, that is up roughly around 75%. And all NASDAQ stocks, while a lot have been strong, the top 100 NASDAQ stocks, you will see that majority, that the money flow relative to the market cap, or if I'm going to put it more simply, you will see that the returns have been much, much higher for cryptocurrencies the past 365 days, year to date, the past 30 days, and the past 7 days, versus what is perceived to be the strongest market today. And my purpose today is to explain to you why that is, why cryptocurrency is essentially the outperformer, and to help you understand what exactly is happening, not just with cryptocurrency, but with the commodity space. The first important reason why cryptocurrencies are going higher, and not just cryptocurrencies, this is something that applies to commodities as well: gold, silver, copper, nickel, and its corresponding companies, such as locally you have Felix Mining, Nickel Asia. Globally, you have Barrick Mining, Newmont Mining, Yamana Gold, B2G Gold, and all these other huge companies. And the number one reason for that is that, number one, we just entered the right side of the dollar cycle. What do I mean by right side? When I say right, I don't mean right or wrong. I mean right kanan. Ano po ibig sabihin nun? I mean the right side of the cycle. Most investors and traders know the fact that financial markets move in cycles. There's a period where prices go up, and then there's a period where prices go down. And for the dollar, we are actually on the right side, where the dollar is actually moving lower. Now, most of you, especially the new ones, may be asking, what does that mean? A right side, every time the dollar moves lower for a considerable period in time, historically, which I will show you in the chart later, has always corresponded to a bull market in commodities or cryptocurrencies. And for those of you who are new to the financial markets, the general relationship is that there is an inverse relationship between the dollar versus commodities over the long term. Now, let me take a second to explain that. To put it in simple terms, if you look at most commodities, all commodities are essentially priced in US dollar terms. If, let's say, you're a company here that needs to buy oil or import oil for, let's say, for your as a raw material to produce, let's say DNL needs that to produce some of its products or to run some of its factories, or Nickel Asia needs oil to run to run its HPAL plant to produce high grade nickel, or other use cases. Since commodities are priced in dollars, not just oil, gold, nickel, cryptocurrencies are priced in dollars, what it simply means is that every time you have a dollar that goes down or is in the right side, what that simply means is that the dollar is depreciating in value. And because the dollar is depreciating in value, let's say, for example, if I'm a company that spends X amount of my local currency to buy X amount of oil, which is priced in dollars, it means that every time the dollar goes down, it means that the same quantity that I'm used to buying, the exact same quantity, also goes down. So that simply means that every time you have the dollar move lower, companies or entities can now buy more of that commodity using their local currency, simply because their local currency strengthened against the dollar. So I hope that was clear. So to repeat that, generally speaking, there's an inverse relationship between the dollar and commodities over the long term. And this chart here shows you the dollar cycle over the past 40 years. It's a dollar cycle over the past 40 years, and you'll see three different cycles. If you follow my mouse cursor over here to the left side, you will see that prices had a period where it moved up and then it moved down. And then we saw another period where prices moved up and moved down. And then we saw prices move up. And what we're seeing now is we're entering a period where prices have already passed an inflection point and are moving down. So allow me to show you the evidence of how a dollar is very important for analyzing commodities and cryptocurrencies. So don't be intimidated by the slide, but this is an in-house slide that we made and presented at the Investagrams Summit last June. And this chart essentially shows you that every time you have the dollar moving higher, as what we see on the left side, you will see that since a stronger dollar corresponds to more expensive bill for the same amount of commodities, for the same amount of cryptocurrencies, for the same amount of gold, nickel, oil, etc., you will see that every time the dollar moves higher, it will always correspond in some Asian or emerging market financial crisis. Why? Because most emerging markets and Asian markets are largely dependent, or their economies are largely dependent on commodities or the export of commodities thereof. Philippines may be an exception to that, but majority of Asian countries, China, Brazil, Russia, India, Chile, etc., are have their economic growths largely dependent on the prices, on the price of the dollar. Now, and you'll see here as a point of evidence that on the left side, as the dollar was going higher, you will see that you had the Latin America debt crisis. Every time you have a stronger dollar, you always have counterparties to the dollar, particularly emerging markets, Latin America, Asia, always run into trouble. So here you had the Latin America debt crisis. That's what happened. And then on the way down, back in the late 80s, that is actually when you saw the Asian tigers boom, or the beginning of the Asian tigers boom. Now, a lot of you may attribute this period, or if you remember in the Philippines, this actually corresponded to a high growth, not just in the Philippine economy, but also in the Philippine stock market, while most people wrongly perceive that because of the EDSA revolution, because we had just entered into a democratic state. A lot of people don't really recognize the major and primary tailwind of a weak dollar during that period. Now, after you have that weak dollar, it was actually during the Asian financial crisis that the dollar started to strengthen again. And it was no surprise that when the dollar strengthened, that every time you have a strengthening dollar, then you have weakness or trouble in emerging markets. If you recall back in the Asian financial crisis, the main problem during that time, at least in the Philippines, was that a lot of Filipinos, businessmen in particular, who borrowed money in dollars, had now a harder time paying their debt because of course, since they were paying interest in dollars and they were using their local currency to change to dollars, imagine if, let's say, you were changing local currency one day from 20 to 20 pesos is to $1. And then now all of a sudden you have to change 50 pesos for $1 of interest. Ibig sabihin nun, more than double yung interest na binabayad mo. The interest burden all of a sudden explodes. And that's essentially what happened. And that's why we had the Asian financial crisis, starting with Thailand, the Philippines, and ASEAN. After that, Asian financial crisis subsided. We had the dot-com bubble, and we had the dollar move to the right side again of its cycle, and that has come down. And that has come down essentially. And for the last 10 years, we have entered a period where the dollar has been going up again. And if you look at what we have here, this was the subprime crisis. And as, let's say, the dollar was spiking higher, central banks counteracted that by printing money that pushed the dollar lower. And then after that, we had a dollar run higher. QT is quantitative tightening for most of you familiar with financial markets. It was quantitative tightening, meaning the opposite of printing money, that actually pushed the dollar higher. And here, over here is when Jerome Powell, JPP is the Jerome Powell quote. This simply refers to the time in 2018 when the Fed was tightening rates, meaning constricting money supply. And then because financial conditions tightened, then they had to reverse course and all of a sudden adopt a more looser monetary policy. Now, that may all sound very complicated, especially for new people here. But the most important point in this slide is that the dollar, after 3 cycles or on its 3rd cycle, may already have passed its inflection point, as you see here. So this white jump over here was a result of the COVID crisis that happened in March. And since March, primarily because of actions that I'll be discussing later, we've had the dollar move lower already. We've had the dollar start to move lower starting April, May, and since June, July have accelerated lower. And that is essentially why when the dollar moves lower, it becomes cheaper for people to buy the same amount of commodities. I mean, that is the oversimplified explanation, but this is essentially the main catalyst as to why we see commodities and commodity-related companies and cryptocurrencies outperforming all other kinds of financial instruments over the past few months. In fact, just to give you some anecdotal evidence, just this Monday, we were in a meeting together with COL financial analysts, and a very good question was asked by one of my teammates, and he asked our mining analyst, George Ching, the question, because George Ching was in a meeting with Nickel Asia, who is one of the largest nickel producers in this country, and the question asked was, why are nickel prices going higher? Is it really because of, let's say, the electric vehicle revolution, meaning the EV, the electric cars with Tesla and NKLA? Obviously, I don't know the name of the company, but I don't know who George was talking to. It was either the investor relations head or the CFO, but the answer was actually no, it's really not because of the electric vehicle revolution or the macro growth theme of electric vehicles. According to Nickel Asia, and this is already straight from the horse's mouth, they said that the reason why their stock price is going up is simply because the dollar is moving lower. And it's not just them, it's all other commodity-related companies around the world and in the Philippines. And that is the reason why. Now, so that is the dollar, at least for the past 40 years. If you look at the dollar chart, this is the monthly dollar chart over the past 20 years, you will see that, and for most traders will understand this slide, we had just last month a breakdown in major support. Now, for those of you who are new to trading and those of you who are new to investing, a breakdown, the simple definition of a breakdown is that it's a beginning of a downtrend. A beginning of a downtrend as long as it stays above this parallel line over here. Obviously, it's not going to downtrend in a straight line, but at least from a dollar weakness point of view, which is what's pushing commodity and cryptocurrency markets, you will see that there is more room to run, at least over the next few weeks and over the next few months. So I hope that dollar narrative has been clear. One thing I'd also like to highlight that has been pushing the dollar lower is that if you look at the United States now, the United States is doing everything it can to fight the COVID crisis, to fight the unintended economic consequences of COVID. You probably might have heard of stories about or have read about stories about the US government even printing money and giving a certain percentage of the population $1,200 checks per month during the last few months. So this has been called fiscal stimulus. Not only that, they've bailed out some of the companies, they've bailed out some of the airlines, they've bailed out American Airlines, Boeing even. Sorry, not American Airlines, but Boeing. And what this chart simply shows is that every time that you have a negative fiscal deficit, and just to explain that for new people, a negative fiscal deficit is simply the US government spending more than what it earns in tax revenues, which means that it spends more than what it earns in tax revenues. And because it spends more, the difference or the gap or the difference between the two, it needs to finance via treasuries or via bonds that it needs to lend out. And if you look at it historically, on the left side, you will see the numbers for the federal deficit. And historically, every time you have a negative fiscal deficit, meaning every time that the US government is spending more than what is earning, at the time when the central bank is adopting, or just to put it simply, at the time when its central bank is printing a lot of money, you will see that that always, at least for the past 50 years, has corresponded to a weaker dollar. So I'm going to repeat that point just so you guys get it. Over the past 50 years, every time you have a negative federal deficit, which means the government spends more than what it earns, if you combine that with money printing, with a loose monetary financial policy, historically, and not on a day-to-day lockstep kind of thing, but more like over the long term or over a monthly and a yearly period, that will always translate to a weak dollar, as what you see here. You see fiscal deficit going down. You see a federal deficit, and that has always corresponded to a weaker dollar along with looser monetary financial policy. Conversely, every time you have a deficit while monetary policy is tight, that's always corresponded with a strong dollar. That is not something that we have today. So just to summarize, that was the first reason why we have commodities and cryptocurrencies coming up. I'll explain more of that later, but just to wrap up, the first reason I just gave you was because we are entering a dollar weak cycle. That's essentially the main point of that. Now, why are we entering a dollar weak cycle? The second reason that I'd like to point out, and the reason why the dollar is moving lower, is simply because the primary culprit responsible for the dollar movement is actually printing an unsurreal amount of money. Now, unsurreal is not really a word, but it's what I thought was best used to describe, because if I'm going to show you later, the amount of money printing that the Fed is doing today is just, it's just drop the jaws of even the most seasoned investors around the world. And what do I mean by that? Why is money printing important? The reason why the Fed is printing a lot of money is simply because it wants to spur or stimulate economic growth in the United States. Obviously, why are they doing that? Syempre, kasi sobrang tinamaan sila dun sa COVID noong March. Syempre, not just in the Philippines, but in the US and around the world, pag tinamaan ka ng COVID, your economy stands to a halt or stops completely. Not completely, but it grinds to a halt. And for those of you who are not familiar with how money supply works, economic growth is simply a function of two things. It's money supply, that means printing a lot of money in the system. And when you have a lot of money in the system, you need the second part of the equation, which is velocity. That means yung ikot ng pera. Hindi lang kailangan marami yung pera sa system, yung liquidity. Kailangan malakas din yung ikot, yung palit ng kamay ng pera. Because yung palit ng kamay, that is what creates economic transactions, that is what creates tax revenue, that is what creates corporate revenue, that is what creates individual revenue and income. Now, on my point that Fed printing is unsurreal amount of money, and this is a chart from Northman Trader. This shows you at the bottom the S&P 500, the US stock market. And on top of that, it shows you the amount of money printed by the US government. And it shows you here that, yes, the Fed unprecedentedly started money printing called quantitative easing back in 2009. And you can see that it was at a gradual 45-degree pace. And then when COVID hit, if you look at the amount of money that was printed, if you see here this vertical move here at the upper right hand of your chart. So just to give you guys some numbers, the amount of money printed by the US back in March to combat COVID was around 3-point-something trillion, 3-point-x trillion, while total central banks around the world printed something to a tune of 18 trillion. And on a global standpoint, the last time it took global central banks to print that magnitude of money, 18 trillion, if I'm not mistaken, was over the past 50 years prior to that. So for the amount of money printed the past 50 years prior to COVID, all central banks printed that in one single month, or at least from the duration of March to April to early May, along with from both the fiscal and the monetary side. And that is essentially what the Fed is trying to do. They're trying to inject a lot of money to the system, money supply, with the hopes that when the velocity comes, then that can create economic growth, which can combat the effects of the virus. Another thing that I'd also like to point out, and this is a new development with regard to Fed policy. Okay, so maybe some background first before I move on to this point. The reason, over the past decade, I have managed money in a bull market. And throughout that time, a bull market and a bear market. And throughout that time, I used to believe that there was a time when I used to believe that the number one driver for stock prices or financial markets for that matter were earnings, company earnings. So that's how I started. And then it came even to a point where I believe that the primary growth driver of, at least in the Philippines, the Philippine stock market, was the Philippine growth story, which meant OFW remittances, equivalent to 20% of GDP, BPOs, demographic dividend, investments as a percentage to GDP. So that was essentially the narrative that I used to believe. Sometime around 2016-17, I started to realize that the number one driver for financial markets was really liquidity or central bank liquidity. That's really an investment philosophy that we have at the core in Buhawi. And that is a philosophy and a bias that I actually bring to the PowerPoint today. So just to give you guys some context. And so with respect to liquidity, with respect to money supply, which is the number one driver for financial markets, the number one source or the only and primary source of that liquidity is really the Fed or central banks around the world. The US Fed, the US central bank is called the Fed. And to my second point, the Fed is printing an unsurreal amount of money, and just as of mid-July, has now been guiding for inflation. So I'm going to be very careful with my words here. In August 4, they announced a revision of inflation target policy to quote unquote more supportive levels. So this was in a speech by Kaplan and Evans, who are the the board governors of, if I'm not mistaken, the Dallas board and the Chicago board, respectively. And what they're simply saying is that for the past 10 years, it has always been the policy of the Fed to target a 2% inflation, which is one of its dual mandates. So it's always been targeting a 2% inflation. What is now circulating around smart money research is that come September, when they announce the new policy framework, and this was in a CNBC article that was just released August 4, there is a high chance that they will be revising the 2% inflation target to 2.5 to maybe as high as even 4% inflation target. Again, for the new people, you guys might be asking, what does it mean? It simply means that the Fed is going all in on inflation, and that after we just came through an economic period where we experienced a deflationary shock because of COVID, what is happening now in financial markets, which is resulting in higher commodity prices, even lower bond yields, lower bond prices and higher bond yields. What is happening now, at least for those people who have some advanced background in financial markets, is that, to put it delicately, we have a softening of deflationary expectations, which means that for the past 3-4 years, if investors were always thinking that inflation would not come, maybe for this particular decade, maybe because they were thinking about the depression or 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 persistently low rates for an extended period of time, low interest rates. At least for the past few months, what has changed is that there's been a softening of deflationary expectations. And what I'd like to point out is that in financial markets, you don't need inflation to appear to come in, or you don't need to see the whites of inflation, so to speak, to be able to push inflation-related investments higher. When I say inflation-related investments, these are gold, silver, commodities, cryptocurrencies. You don't need to see inflation appear. All you need to do is to soften or to weaken the expectations on deflation, or to at least to guide people that to expect inflation moving forward, which is what we're seeing the Fed do via their forward guidance. Not only are we seeing a softening of deflationary expectations in the form of words by the Fed, love languaging words today, but we're also seeing that evidence in financial markets, as I'll show you later. So, as most of you know, over the past few months, we've seen huge rallies in gold, copper, nickel. We've seen rally in cryptocurrencies. And these are essentially evidences of inflation, which financial markets are expecting down the road. Remember, prices or financial markets will always be a leading indicator of what is to happen 6, 12, 18 months down the road. And what financial markets are betting right now is that they're betting, because the Fed is going all in on inflation, guiding for inflation, they're betting that you're going to see some inflation come down 6, 12, 18 months down the road. And that's precisely why commodities and cryptocurrencies are moving higher. So it's very interesting. It will be very interesting to see how this would develop further on. But so that's really the second reason. So just to recap, the first reason why we say that cryptocurrencies may have entered a bull market from a major probability point of view is, number one, the dollar has pretty much entered the right side of its cycle, which has historically led to a bull market in commodities and cryptocurrencies. And the reason why the dollar is moving lower is simply because to this number, to this second point, because the Fed is printing an unsurreal amount of money. Now, before I move forward, the dollar is moving lower simply why? Because when the Fed is printing an unprecedented amount of money, if you create more supply of a certain thing, then obviously it pushes prices down. Just imagine, let's say, if all of a sudden, let's say, for example, back in 2017, Vietnamese imports flooded the Philippine market with imported cement. Now that resulted in cement prices going lower by 30, as much as 40%, right? Because you have more options, more supply of the same commodity. And it was for that reason that we saw companies like Holcim, CHP, Cemex even go down significantly because they lost pricing power because prices of their commodities went down. And that's essentially what's happening with the dollar now. The Fed is printing a lot of dollars to support the US economy. And because they're printing an unsurreal amount of money, that is devaluing the dollar and pushing the price of the dollar lower. I hope those 2 points were clear. We can entertain some questions related to those later. But the third point that I'd like to point out as to why cryptocurrencies and commodities have entered the bull market is the reason why the Fed is printing money. It has been evidenced in the minutes and in press conferences that the reason why the Fed is printing a lot of money is not just to support the economy, but they also want to push money out of bonds and into more risky assets. Now, just to clarify, if you look at the different financial markets that are available, obviously you have bonds, which is the second largest, which is also known to be a safe kind of investment, a not risky type of investment. And then you have equities, commodities, which are risky, and then you have cryptocurrencies, which are more risky even. Now, the Fed has stated that they want to push money out of bonds and into more risky assets. And because out of these risky assets, because historically, the asset classes that have historically proven to be the best or the fastest horse in terms of all these risky assets going up, the fastest horses have always been proven to be the inflation hedges or the hedges to inflation, the asset classes that have been known to be choices to be hedges to inflation. And those have been commodities, gold, silver, precious metals, and to a certain extent, soft commodities. So commodities have been a primary beneficiary. So if we look at financial markets, this is the 20-year bond. This is the US 20-year bond price. And this is the TLT 20-year bond price. And you'll see that the 20-year bond price, we already broke down just this August over here, which could be the beginning of a down move over here. So prices have peaked over here, and then prices have now started to move lower. And what this simply shows you is that bond markets are already to show evidence or are already starting to price in inflation. So this is the 20-year starting to price in inflation already. So this is something that we're watching very closely with respect to this investment thesis. This is a chart that's care of Larry McDowell of the Bear Traps report. Another chart I like to show you is the 10-year versus is at least a chart that shows you inflation expectations, not by the Fed, but by the financial markets in general. So this shows you, the white line shows you the 10-year TNX or the 10-year US bond. And it's very important to note that over the past few months, the Fed has been buying a lot of that, suppressing those yields down low. But if you actually look at the 10-year break even, which is a variation of the 10-year TNX, just to give you a simple background, the 10-year break even is a 10-year bond that is simply weighted to reflect inflation expectations. Okay, so that's the simple explanation, and it shows you that those have been going higher at least for the past few months, and that shows you that financial market participants in general, whether it's the hedge funds, the commercial funds, investors, big investors, smart money, are starting to bet on inflation that we could be seeing 6, 12 months down the road. So that's the bond market starting to price in. And I mentioned earlier that the Fed wants to push money out of bonds and into risky assets. And this is a simple chart as to how they're doing that. Now, this is an important point, so I need you guys to listen very carefully, especially for new people who are very new to the financial markets. When I say that the Fed, through its money printing, wants to push money out of bonds and into more risky assets, which we will eventually see flowing not just into commodities but cryptocurrencies, what this simply means is that the reason why the Fed wants to drive inflation higher is simply because it wants bond yields to go negative. And when I say bond yields, I mean real bond yields. That means the coupon rate, the nominal, less inflation. Okay, I'm just going to keep it simple. It simply means that they want bond investors to lose money. What do I mean? Let's say, for example, you are let's say a prince of Brunei. You're living very comfortably. You have 50 sports cars. And then let's say you have 50 billion in investments in, let's say, US bonds, $50 billion. Obviously, when you count your investment, as with any investment, you always have to subtract the rate of inflation to get the real yield or to get the real return. Let's say your bonds are doing, let's say 3%. Or let's say 3% is a stretch these days. Let's say your bonds are doing in the US, they're doing 1.5%. Or let's say they're doing 0.5%, which is what US 10 years are doing right now. Let's say you're putting money in US 10 years, which is giving you 0.5% per year just to preserve your capital. You think it's preserving your capital, and then all of a sudden, because inflation is going higher, inflation is now 1%, 2%. In the US, inflation currently is just under 1%. It's a shade under 1%. However, what if 6 months down the road, 12 months down the road, since the Fed is going all in on inflation, they're trying to push that to 2%, 2.5%, 4%. Then all of a sudden, your 0.5 less inflation, less 2%, you're now losing money in that particular financial product. You're now, instead of making 0.5% on your bond, preserving your capital, you're now losing 1.5 per year on $50 billion. Let's say if you are a large fund, or let's say even if you're a pension fund, or even let's say for government funds like GSIS or SSS, who I'm sure have money in US treasuries. The reality is, is that these investors are not only losing money on the coupon return because of inflation, but keep in mind, while their money is in US treasuries, it's in dollars, which means that while they're losing money after inflation, the dollar currency that their investment is in is also devaluing, which means that eventually they're going to take a loss when they convert their bonds back to pesos later on. And just to give you some numbers, in a bond market of 100 trillion, there are already, as of the latest figure, 15 trillion or 15% of all bonds now in negative yielding debt as of today. And this is already up just from 5 trillion 2 years ago, back in 2018. So that was a 3 times jump that was a 10 trillion jump in money that is now losing. And obviously when you're losing, this money is now looking for a home or for other financial markets where they could put money to work. And historically, what has been the financial market that has benefited every time yields go to negative real rates, or to put it simply, when inflation starts to come in? Um, this market has historically been the commodities market or the precious metals market. So this used to be the biggest beneficiary back in the dollar cycle, in when the dollar cycle went down in, let's say, the mid 2000s, and then after that even in the late 90s. But just to show you, this is the 100 trillion bond market. And if 15 trillion of that 100 trillion is already losing money, as by design by the Fed, what the Fed is trying to do is that it's trying to push money out of this bond market and into these other markets, where you have a commodity market, which is a 20 trillion market. And note, commodities such as oil, gold, silver, soft commodities, not all of them benefit during inflationary periods. Some benefit more than another, but generally that is a 20 trillion market. You have gold, which has always been a hedge to inflation, which is 8 trillion. And the simple reason why gold has been a hedge to inflation is because it's been a store of value, a reliable store of value during periods when bonds start to lose money because of inflation. Because, to put it simply, why put your money in a bond that's losing, let's say, 1.5% a year, when I can keep my money in gold, where I have zero carrying cost, zero storage cost? Well, there is some storage cost, but at least I'm preserving my capital. At least in this case, this is also why we've seen gold prices move into a bull market the past few months, or at least the starting early this year. So here we see again bond money, 15 trillion, coming from 5 trillion last year, that are losing money, that are now thinking, how should I put my money to work? We're seeing some of that money move to inflation hedges such as gold, commodities in general. And obviously, these aren't markets where money can flow into, but I just wanted to put them there to show you the relative size. But it's also flowing into the cryptocurrency market. So if you'll see here, the cryptocurrency market as of an hour ago is a 368 billion market in terms of market cap. What that simply means is that the total size of the cryptocurrency market is 368 billion. If you look at Bitcoin, which is the poster child for cryptocurrency, that market size is 217 billion, which is less than 20 times the size of the gold market, and 1%, yes, 1% the size of the commodities market. Now, virtually, since you have money flowing out of the bonds, even if more money flows into gold, even if more money flows into commodities, the fact that the cryptocurrency market is a very small market, even if money flowing into the cryptocurrency market is much smaller than what's flowing to gold, just because of the size of the cryptocurrency, the Bitcoin market, that's precisely why you're getting a lot of big moves in cryptocurrency, because it's still a relatively small market versus, let's say, gold, versus silver, which is part of this, versus soft commodities, which have lagged precious metals in this recent run-up because of a weak dollar, because of a softening of deflationary expectations. And the fourth point I'd like to make as to why cryptocurrencies might have entered the bull market is that has resulted in T's or trillions of funds flows, and thus a broad-based breakout in commodities, including cryptocurrencies. So that has resulted in trillions that has gone into, if I'm not mistaken, the total amount of money that has moved out of bonds already is already more than 1 trillion. And obviously, I don't know the specific number for each market, but more than a trillion has already flown into commodities, including cryptocurrencies being a part of the commodity basket. Now, so you see here the evidence starting March, starting the low, since the Fed started printing the unsurreal amount of money, you saw base metals, which means precious metals, including nickel, copper, start to move higher. And then after that, you saw a pullback in the soft commodity index, and we saw that start to move higher. So this is a broad-based move among commodities, the money moving out of bonds. And when I say soft commodities, I'm referring to, let's say, coffee, OJ, that means orange juice concentrate, that's the commodity. You have cattle, soybeans, wheat, corn, those kinds of soft commodities. So those soft commodities have also experienced some uplift in demand because of the money moving out of bonds as being engineered by not just the US central bank, but central banks around the world. So this chart is care of Real Vision. And if you look at the performance of the commodity space since the unsurreal money printing began by the Fed, meaning the 3 point something trillion back in March, April, May, and 18 trillion across global central banks, across the G7 central banks. That includes, the G4 central banks. That includes the Bank of Japan, the ECB, the European Central Bank, and of course the Bank of England. You'll see that since that amount of money supply has flooded the system in a vertical way, as you saw on the North One Trader chart earlier, you saw that a lot of these commodities have started to go higher simply because a lot of money from bonds have started to look for a home to protect themselves from inflation. Now, this is an outdated chart. This is a chart as of end July, or if I'm not mistaken, August 1, August 2, but you'll see here that the biggest performers, obviously, during the time were the miners, meaning the mining companies, simply because they benefited from the added operating leverage because of the lower oil prices. But that's a different story. But you saw silver and gold prices move higher. Not only that, if I'm going to update this chart today, you will see that Bitcoin prices have actually already reached the level of, or if I'm not mistaken, have already surpassed the level of gold already. So if I'm not mistaken, since the March low, silver is up 130%, gold is up 40%, which has been the laggard, and Bitcoin, which is the poster child for cryptocurrency, has been up a lot more than gold, Now, or if I'm not mistaken, times 3 of the March low. Now, within cryptocurrencies, these are some of the other cryptocurrencies that have moved higher since the March low. So you'll see that this is Bitcoin. This is the red chart. This is the red line. That's Bitcoin. And along with Bitcoin, you'll see other cryptocurrencies such as Ripple move, maybe not to the same degree as Bitcoin, but you'll also see, let's say, the leader, at least so far for this cryptocurrency rally since March, has been Ethereum. You'll see that since March 29 low, which is the low in cryptocurrency, you'll see that Ethereum has gone up by 300%. That's times 3. Bitcoin has doubled since the March 29 low. That is more than double the performance of gold. Not able to catch up to silver yet, but we'll see. But you'll see here other cryptocurrencies such as, let's say, Stellar, which is up more than double, Ripple, which is up 80%, Litecoin up 56%, and the laggard Ethereum Classic, which is only up 46%. So all these cryptocurrencies, with the exception for Stellar, are available on the PDAX platform, with the exception for Stellar and Ethereum Classic. Now, possibly the most important chart for traders and for investors who understand technical analysis. The reason why we also say that cryptocurrencies have entered the bull market is because the evidence of price action. And this is the Bitcoin chart since it began. So this lacks some early data. But you see the general trend, it's gone up. And since the peak in 2017, where we had that crypto craze, prices have pretty much gone sideways. And just since this is a weekly chart, just 2 weeks ago, or 2.5 weeks ago, we had a breakout in this area pattern, And for those of you who don't have any background in technical analysis, A breakout is simply a beginning of an uptrend. That is essentially what a breakout means. And that is precisely why that for those of you who follow a lot of the famous traders, macro investors on Twitter, you'll see that a lot of the or that you'll see that cryptocurrency has been trending recently, at least, or you'll see a lot of these investors are now starting to switch or allocate capital to cryptocurrency. So again, this is the this is the weekly chart. I'm sorry, this is not a monthly Bitcoin chart. This is a weekly chart of Bitcoin as of today. And since then we had a breakout or a beginning of an uptrend. Not only has Bitcoin or cryptocurrency attracted many traders, it's also attracted some of the top traders. In fact, possibly even the top trader alive today, which is Paul Tudor Jones, who released a research report 2 months ago. And this is just a quote from his research report. He says that what will be the winner in 10 years' time? At the end of the day, the best profit maximizing strategy is to own the fastest horse. Just to own the best performer and not get wed to an intellectual side that might leave you weeping in the performance dust because you thought you were smarter than the market. If I'm forced to forecast, my bet is it will be Bitcoin. Now, to give some context, he was actually comparing Bitcoin to gold, silver, and other relevant commodities that would benefit from what he called a GMI, or a great monetary inflation, which simply means a period in our history where we have an unsurreal and unprecedented level of money printing, which can bring inflation. So I hope this is clear. I'm sure some of you traders out there would have just preferred to just see this chart and okay na ako, convinced na ako, di ba? But obviously we want to give you the narrative to be able to help you understand what's happening and obviously to add value more than what you can see in the chart. Now, I'd like to move on to the most important part of this presentation, and that is understanding the major risks, at least to this investment thesis, or at least this macro narrative, at least the risks that we're watching very closely, and the risks that I will even go to an extent say would invalidate the thesis altogether. So these are risks that I'd like to point out that if they would happen, it would mean all bets are off. And when I say all bets are off, it means that we're getting out of the position and protecting the capital and avoiding any further losses. So I'd like to start with the first one. The first risk is essentially what a lot of pundits also say. One of the things that the things that I like to do during my spare time is that I like to watch Real Vision, which is sort of the Netflix for finance. And you have some experts there, a few that say that hanggang salita lang yung Fed. Yun essentially sinasabi nila. Why? Kasi according to them, the Fed has a poor track record in delivering inflation. According to them, over the past 10 years, the Fed, yes, has been guiding a 2% inflation target. Pero never naman, with the exception for 2017, never naman nila tinamaan yung 2% inflation target. So why even consider a 2.5-4% inflation target or a revised inflation policy target higher when they can't even hit 2%? So that's something that we actually thought about and considered behind the scenes with consideration to at least this whole inflationary macro theme that's been coming. And one of the things, the factors that pushed us over the fence to consider betting on the inflation story, obviously the most important is price action. I mean, that's ultimately what convinced us. But what has really pushed us also over the fence is, number one, we are a point in time where we've never seen a higher growth in money supply. So the money supply growth has been unprecedented, which means that if you look at money supply metrics such as M2, you'll see that M2 has never been this high at, if I'm not mistaken, growing 220 3% year on year. So that's the M2 number that you have in the United States right now. Not only that, this is also a point in history where you have both the fiscal and the monetary side of the United States working in concert together to provide stimulus. So this is something that we've never seen before in at least the past 30 years from what I remember, from what I read. And it's only the first time that we're seeing monetary policy done in a way to finance fiscal stimulus. What it means is this is the first time we're seeing the Fed, central bank, print money so that they can give it to the government, and then the government can use that to choose to bail out which companies, to choose which part of its demographic population to give the stimulus checks to, the $1,200 checks to. And right now, as we speak, the latest news that has come out is that, obviously, if you guys have been following the news, in terms of the added fiscal stimulus, which has been expected this August since the fiscal stimulus ended in July, the latest news is that has gone into a stalemate in terms of what both political parties can agree on in terms of the size, in terms of the details of which. So that's been the latest news. But what's also interesting is that the Fed has also parked, at least if you go into the details, has parked in its Treasury General Account an amount of 800 billion as a stimulus that they're supposed to release prior to September. So at least with that, we know that there's more stimulus to come, more than what's already been released. And that, coupled along with the Fed coming out with a revised policy framework as early as September, is at least an environment that's supportive enough for the inflationary narrative that's driving cryptocurrencies and commodities alike. So I hope that's been clear. That's essentially, and obviously that has been supported and evidenced, and price action has validated that, and that's precisely why. That's also precisely why we're even confident enough to do this presentation and to even guide people and to at least help people understand the narrative as to what's happening with cryptocurrency. Now, the second major risk. So just to wrap up the first major risk is inflation expectations are disappointed, which means that financial markets expect inflation, financial markets are going up, and then inflation doesn't come, and then all of a sudden markets reverse. So that's obviously something that can happen, and that's something we're watching very closely. However, financial markets have always been a good predictor. I mean, in the words of one of the greatest investors alive today, or the greatest investor alive today, Stan Druckenmiller, in his words, the best forecaster or economist he knows is the inside of the stock market. So I'll repeat, he said that the greatest economist or forecaster that he knows is the inside of a stock market. And what he simply means by that is that more than any other economist na nagmamarunong dyan, which generally have a very poor track record, more than any other economist or forecaster, or even, I would even say, market strategist, the best predictor of future trends in the economy is always what's happening in the stock market, simply because the stock market is a discounting mechanism. What I mean by that is that the stock market will always represent what will happen in the economy 6 months, 12 months, 18 months down the road. And if financial markets right now, as I showed you, bond markets are starting to price in inflation, inflationary hedges are moving up, which means they're starting to price in inflation, then it means that from a probability point of view, then there is a good probability that we could see inflation 6, 12 months down the road. And obviously the act of investing is positioning for what you think is going to happen 6, 12, 18 months down the road. Now, the second risk that we would like to identify is a potential equity market weakness, which can create a liquidity sell-off in cryptocurrencies, just like what happened in March. Now, as a So what I want to show you here is a study or is a chart. It's essentially a correlation study across different asset classes done by Pantera Capital, which is a hedge fund that manages money in crypto markets. And what they show here, the simple message here is that Bitcoin is the least correlated asset to the S&P 500 over here. So you see that Bitcoin over here is the least correlated asset to Bitcoin. So you'll see here it's zero. There's zero color correlation over the long term. It's the least correlated asset compared to Europe, compared to oil, compared to commodities, compared to silver, compared to gold, which gives you the idea that it can be used as a diversification tool. However, that is not the case. So just to give you guys some full transparency, we, at least in Buhawi, have been pursuing the crypto space since Q1 2020. So that was when we started deploying. And this is what we had assumed initially, that Bitcoin was not correlated with the equity markets. And as you guys already know, when March came, when we were watching equity weakness in relation to cryptocurrency weakness, we were watching the correlation, and then we saw as evidence that cryptocurrency sold off together with all financial markets, together with equity markets. As you know, as most Filipinos know, noong March, ang laki ng binagsak ng stock market ng Philippines. That's when prices accelerated lower. And even cryptocurrencies, if I'm not mistaken, during a 1 hour stretch, along with all financial markets, dropped 40%. Full transparency, that's actually one of the challenges that we went through over the past few months. And that was actually a challenging period for us. And that was actually, we were fortunate enough to hold through most of that weakness simply because of capacity constraints. So that's essentially the risk ahead, is that as US markets are moving higher, obviously US markets are approaching overbought. US markets are narrowing in terms of breadth. And that is usually although not a good timing tool, it is a good leading indicator of potential pullback ahead, of a potential pullback or a potential correction ahead. As to what kind of correction or pullback we'll see, it really depends. You just have to take it as it develops and to see which support levels hold. But this is one of the risks that we actually are monitoring ahead with respect to the narrative in commodities and cryptocurrencies, not just for crypto, but commodities as well. So the third risk, and I'd say this is just maybe the most important point in this presentation. If the risks discussion is the most important part, this is the most important 30 seconds of this presentation. And what this next 30 seconds will say is that if this is Bitcoin and prices just broke out, it's simple. If price goes back below the breakout point, meaning below this resistance line over here or below this blue line over here, that simply means all bets are off. That's simply what it means. It means that how price moves will be more important than all the due diligence that we did to understand this macro narrative as to why commodities and cryptocurrencies are moving higher. It means that price is telling us something different, and it means that we need to listen to price. And if we want to prevent small losses from becoming big losses, then we need to be able to get out. So that's one of the major risks that I like to point out if prices go back below that. Now, what I'd also like to point out at this point in time is what I've run you guys through is the macro narrative. And even from a technical analysis point of view, I've just shown you the Bitcoin chart. I mean, in Open Journal, in our community, even in Buhawi, we look at as much as crypto charts as we can. Which charts are breaking out, where's the opportunity, so on and so forth. And what I only detail here is the macro narrative. To be explicit, it does not include the timing aspect of the analysis, which as traders who are listening in is extremely important. It also does not include the stock selection or the crypto selection process, which means which of the, let's say, the top cryptocurrencies will perform the most, more than most of the other cryptocurrencies. So that is something that is part of the value add that we do, not just in Buhawi, but also in Open Journal. And because it's only a macro narrative and does not include important parts of the analysis needed to buy or sell specifically, I would even go to a point and say that this is purely for educational purposes and to help people, not only for educational purposes, but to also show you essentially where you should be focused in terms of putting your efforts, in terms of consulting professionals, in terms of which platforms you should allocate money to, in terms of which financial markets that you should choose, whether it's, let's say, gold or crypto or or Philippines or crypto or bonds or forex or commodities, crypto, so on and so forth. And lastly, I just like to be explicit that we advise against the use of leverage. If, let's say, you guys end up following this focus, following this tact, then leverage, I mean, obviously, this is not a recommendation to buy or sell, but for those of you that won't be listening, we just want to say that we don't advise against the use of leverage, or even Buhawi, we don't use leverage for our clients. Okay, so just to end my presentation, I would be remiss if I didn't mention, obviously, PDAX. Again, thank you to PDAX, Kyle. Thank you to Nichelle, who actually was the person who suggested this. And so they're the platform that we actually use to manage assets for at least the crypto space, for at least the crypto opportunity that we've been pursuing. I'd also be remiss if I didn't mention the Open Journal family. Shout out to all Open Journal family members. Hello. Hope to see you guys tomorrow in our session. And just to give you guys some context, in 2019, while we were really focused in managing money professionally, in 2019, when we saw potential for weakness in not just Philippines, but in emerging markets, I'm sure some of you guys are familiar that we, for the whole second half of 2019, para kaming silang plaka, I love you 6,000, I love you 6,000, when the market was at 8,300, 8,000, 7,900, we were saying that the market could go as low as 6,000. We were wrong. It went down to 4,000 instead. And we thought at the time that what was the best way to really add value when we saw that there was a potential for a market sell-off. And we said that if you really want to add value in financial markets, not only do you need to call the flood, you also need to learn how to build the ark. And that was really what Open Journal was about. It was not just about warning people what was coming. It was also about building the ark, teaching them how to navigate a volatile market, financial market, and it was at least designed for traders and investors who were full-time, who really had money in the markets and who really relied on their livelihood from the markets. So it's designed to help them step aside from that and to teach them a system that would teach them a system that would help them pursue the strongest markets. And it just so happened that through the analysis that we do, the strongest market that we found, at least the land of that ark, turned out to be cryptocurrency. And that's what we've been doing for Open Journal. Open Journal, full disclosure, is a paid subscription. Now, I'm sure some of you, especially during this time, don't want to pay, or at least are this is the last time that a lot of people would really like to shell out to pay something. But if you guys would like something free, we have something free as well, and that is you can just follow me on Investagrams, investagrams.com. My handle is Taylor, @Taylor. And we have there an Investa group called free_open journal. You can see the link in my posts. You can just click on that and we'll accept you. And we don't post all of our crypto material there. All of those are obviously reserved for open journal, but more partly for the Buhawi investment management clients. But we do post updates to the crypto narrative, or we did post an update to the crypto narrative there last week. So if you can just follow me there, it's free, or if you can just join the group, that's free as well. Now, I'd also like to at least point out the investment management group that at least that I'm part of, that I'm CIO of, that I co-founded along with Matt and along with Luis, who's a part of us. And this is essentially the fund where we manage clients for cryptocurrency. So some of you have asked, there was a person who asked me yesterday, how do I become a client? You can just, if you're interested, just PM me if you're interested. Usually we have a minimum deal size of around 3 million for that pesos. But if you guys are interested, then just PM me. I don't want to waste the audience time with more details on that. So with that, again, I'd like to thank everyone for taking the time to listen. I hope you guys learned something new. I hope you didn't need any tissue for any nosebleed that happened. I'm sorry, but I tried to keep this as simple as possible. I hope it was insightful for not just the new people, but for the seasoned traders and investors who participated. And I'd also like to thank PDAX, who took the initiative to sponsor this event. So with that, I'd like to say thank you, happy weekend, and